What is going on in the housing market? Let me start with this. If you've been feeling confused, you're not crazy. Every week there's a new headline. Trump wants to ban big companies from buying homes. People might be able to use their 401ks to buy a house. No capital gains tax when you sell your home. And a 50-year mortgage is coming. And depending on who you listen to, this is either the best housing opportunity of a lifetime or a ticking time bomb. So the real question isn't just what's going on in the housing market. The real question is what's actually real, what's political noise, what's already dead on arrival, and what direction is the market actually moving in regardless of who's in office. Because whether you're trying to buy a new home, thinking about selling, thinking about investing in real estate, or just trying not to get financially crushed, this market impacts your life. And today, I'm going to break it all down. Just facts, incentives, and where the path realistically leads. Welcome back to the channel where business, money, and investing actually makes sense. Do me a quick favor, hit the like button, subscribe, and share this channel with someone who needs to see it. It really helps the channel grow and lets me keep putting out clear, practical investing content like this out every week. All right, let's get into it. Why does everyone feel so confused right now? Let's start with the emotional reality of the market because everything feels so weird. It's not crashing, it's not booming, and it's not cheap, but it's also not completely frozen anymore. Prices are high, rates are high compared to recent history, inventory is finally coming back, but affordability is brutal. People are asking, if rates are high, why are prices not falling? If prices are high, why are buyers still buying? If demand is slowing, why isn't this collapsing? The reason is simple. We are not in a single market anymore. We are in multiple housing markets at the same time. Let's talk about the Trump proposal. What's real and what's rhetoric? Recently, Trump has floated several housing-related ideas. Some are serious policy discussions, some are political messaging, and some are trial balloons testing public reaction. Let's separate the signal from the noise. He recently announced a proposal to ban big companies from buying homes. This one gets the most applause and the least understanding. The idea is to limit or ban large institutional investors from buying single-family homes. Think BlackRock, hedge funds, or private equity. On the surface, it sounds great. Stop Wall Street from stealing homes from families. But here's the reality most people miss. Institutional buyers make up less than 3% of the total housing stock nationally. In some local markets like Phoenix, Tampa, and Atlanta, they matter more. But nationally, they are not the primary driver of high prices. The real drivers are underbuilding for 15 plus years, zoning restrictions, population growth in job centers, and people staying put because of low rate mortgages. Banning institutions would help slightly in a few metro areas, do almost nothing nationally, and potentially reduce rental supply. Also, enforcement of this would be incredibly complex. Would it apply to LLCs, family offices, small funds, or REITs? This proposal is popular politically, but limited economically. Another recent proposal was using 401ks to buy a home. This idea comes up every cycle to allow people to tap into retirement accounts for down payment or purchases. Here's an honest breakdown. Let's look at a few pros. This helps first-time buyers with down payments and immediately increases your purchasing power. Looking at a few cons, it drains retirement savings, increases long-term financial fragility, and pushes prices higher if supply doesn't increase. This is a key lesson in the housing policy. If you stimulate demand without increasing supply, prices go up. That's not ideology, that's the math. This idea doesn't fix affordability, it shifts it forward in time. The next proposal was no capital gains tax on a home sale. This one's interesting, but it's misunderstood. Primary residences already have $250,000 capital gains exclusions if you're single and $500,000 if you're married. So this wouldn't affect most homeowners. Where it would matter is high coastal markets, long-term owners with massive appreciation, investors converting properties. But again, the incentive matters. Removing capital gains encourages selling, frees up inventory, and could reduce the lock-in effects. This is one of the few ideas that actually target supply indirectly, but it's also expensive for the government and politically hard to justify. Now let's talk about the most controversial idea. Is the 50-year mortgage a game changer or a trap? The goal was simple. Lower monthly payments. On paper, it works. Stretch a loan from 30 to 50 years and payments drop about 10 to 12%. On a medium priced home, that's $200 to $250 per month. That sounds great until you zoom out. As of January 12, 2026, the administration has backed away from this idea. Why? It's because the downsides are brutal. First is with an interest explosion. On a $400,000 loan, a 30-year mortgage already is painful enough paying the interest. Now, with a 50-year mortgage, nearly double the interest paid, you could pay over $800,000 of interest alone. There's no equity buildup. You would build equity at a snail's pace. It would take nearly 40 years to pay off half the loan. Now, that's not ownership, that's long-term renting from a bank. There's legal barriers. Federal law caps qualified mortgages at 30 years. Changing that requires a change from Congress, and there is very little appetite for it. There's higher rates. Banks would charge higher rates for higher risks. That wipes out much of the payment savings. Let's ground this in reality. Here's what the market actually looks like today. Mortgage rates are around 6%. That's lower than 2024 highs, but it's also higher than pandemic lows, and it's unlikely to hit 3 to 4% anytime soon. Inventory is up roughly 20% year over year. This matters more than headlines. More inventory means more choices, less panic, and fewer bidding wars. Buyers' leverage is increasing. Sellers are offering closing cost credits, rate buydowns, and repair concessions. This was unheard of 2 years ago. Here's a phrase you need to understand: the great rebalance. After pandemic stimulus, ultra low rates, investor frenzy, and inventory collapse, the market got distorted. Now it's slowly normalizing. It's not crashing, it's not booming, it's rebalancing. Now let's look at the stably expensive path. Prices are no longer skyrocketing. Most forecasts estimate in 2026 1 to 3% appreciation, roughly in line with inflation. That's not a bubble, that's a slow grind. The end of the lock-in effect. Most homeowners are sitting on 3% mortgages for years. They refuse to sell, but life doesn't stop. People get divorces, they change jobs, they have kids, and they retire. As rates stabilize near 6%, more people are listening. That's why inventory is rising. There's regional split markets. This is critical. We are seeing haves and have-nots. The Midwest and Northeast steady and competitive. Florida and Texas, there's flattening and dipping. There's regional split markets. This is critical. We're seeing haves and have-nots. In the Midwest and the Northeast, prices are steady and the market is competitive. In Florida and Texas, it's flattening and dipping. And in overbuilt Sunbelt market metros there's inventory pressure. This is not a national story anymore. Here's what most people are missing: the supply shift. This is the biggest piece most people aren't talking about. For years, the government tried to subsidize buyers, stimulate demand, and juice affordability artificially. It didn't work. Now the focus is slowly shifting to supply. There's a proposal about opening up federal land. There's an active discussion about selling federal land for affordable housing development, especially for starter homes, townhomes, and workforce housing. This matters long term. There's zoning reform pressure. The federal government can't force zoning changes, but it can apply pressure. There's funding incentives, infrastructure dollars, and transportation grants. Cities that refuse density may lose money. There's another proposal about portable mortgages. This idea is flying under the radar. It allows homeowners to take their existing low rate with them to a new home. If this happens, millions of stuck homeowners can suddenly list. This would flood inventory overnight. This is one of the few ideas that could materially change the market. So let's answer the big question. Where's the housing market going? It's not going to crash, and it's not booming. There's a long, slow normalization. Here's what that looks like. Modest price growth, higher inventory than recent years, more balanced negotiations, less frenzy, and still tough affordability. Housing doesn't collapse when people have jobs, lending standards are tight, and inventory is controlled. This isn't 2008. This is something new. What does this mean for you? If you're a buyer, you have more leverage, you can negotiate, you can take your time, and you should stop waiting for a crash. If you're a seller, pricing matters again. Overpricing will sit, presentation matters, and the list it and they'll come era is over. If you're an investor, cash flow matters more than appreciation, markets matter more than ever, and conservative underwriting always wins. If this video helped you, make sure you like, subscribe, and share this video with someone who's confused about the housing market right now. Drop a comment below. Let me know where you're buying, where you're selling, or what you're waiting on. And I'll see you in the next one.